Welcome to vTalkInsight, Allocator's Lens Daily for April 7th, 2026. Cross-asset attention has swung back to the collision between an intensifying energy shock and sticky inflation data, just as equities and bonds are both wobbling and the dollar regains safe haven status. The key question now is how far this stagflation scare runs, and which parts of the opportunity set can still absorb it. Starting with equities, U.S. benchmarks have been remarkably resilient given the backdrop of war-related oil disruption and rising yields. The S&P 500 is only modestly below its highs and has logged recent gains, while volatility has eased off last week's spike. Yet positioning and commentary suggest investors are nervous rather than complacent. The dominant macro swing factor is inflation. Core personal consumption expenditures and the next consumer price index prints near 0.4% month-on-month would confirm sticky price pressure just as Brent trades around $100. That keeps alive the risk that inflation reaccelerates into the second half of the year, which is now being highlighted as the primary macro threat to U.S. equities. At the index level, valuations remain demanding. Forward price to earnings ratios near 19 times, combined with earnings growth assumptions around 17% for 2026, leave little cushion if growth or margins disappoint. Underneath the surface, breadth is much weaker than the headline suggests, with roughly half of U.S. stocks already trading more than 20% below their one-year highs. Materials, consumer-facing names, and other cyclical winners from earlier in the year have lagged sharply as the Middle East conflict and higher fuel costs bite into expected demand. Energy equities have been volatile as crude prices move with ceasefire headlines, and recent profit-taking in some oil majors contrasts with the view that sector valuations still only discount mid-cycle crude prices. That tension highlights how sensitive these stocks are to any shift in the perceived durability of the oil risk premium. By contrast, technology and defense remain the key pillars of equity resilience. Semiconductor and hardware demand tied to artificial intelligence is still described as robust, with a memory supercycle, component shortages, and strong orders into Taiwan and Korea supporting multi-year growth narratives. Large-cap platforms such as Microsoft are trading at decade-high multiples, but forecasts for mid to high teens free cash flow growth and continued AI adoption are seen as capable of justifying those valuations if delivery meets expectations. Sell-side upgrades across storage providers, rising cybersecurity budgets, and strong prints from suppliers like Foxconn reinforce that story. Capital markets activity echoes the risk appetite in these pockets. Record first-quarter mergers and acquisition volumes. Healthy initial public offering pipelines highlighted by potential mega deals such as SpaceX and OpenAI, and strong demand for new equity and equity-linked issuance all point to a market that is still wide open for quality growth stories despite geopolitical noise. Even so, the balance of views on equities is finely poised. On one side, stable credit spreads, solid earnings, and contained year-to-date drawdowns support the argument that risk assets can weather a soft landing backdrop. On the other, momentum indicators point to an ongoing corrective phase, with recent rallies used to sell upside calls and rebuild hedges rather than to releverage. Nearly half of stocks already in bear market territory, combined with rising oil and a 10-year yield north of 4.2%, underline how much of the risk is now in valuation multiple compression rather than earnings collapse. For allocators, the next key catalysts are the inflation data in coming weeks, early signals from bank earnings on credit demand, and any escalation around the Strait of Hormuz that could push energy prices deeper into stagflation territory. Those same inflation and energy dynamics are increasingly being expressed through the rates market. In rates, the story is shifting toward a higher-for-longer equilibrium. Strong recent payrolls have largely removed expectations for Federal Reserve cuts this year, and some commentary even entertains the possibility of renewed hikes if inflation surprises to the upside. Market focus is now squarely on core consumer price index and personal consumption expenditures prints that are tracking around 0.4% month-on-month, before fully accounting for the latest commodity spikes. A run of such data would cement the view that underlying inflation is too sticky to allow early policy easing. In that scenario, a 10-year Treasury yield pushing toward 4.5% is being flagged as a potential danger zone where risk assets more broadly tend to struggle and cash-like instruments regain appeal. Yields have already broken higher, with the 10-year moving above important resistance, near 4.2%, and investors discussing the next band of resistance closer to 4.75. The curve has cheapened, yet long duration has not rallied despite growing concern about global growth, because investors worry about both persistent inflation and heavy supply. Rising fiscal deficits, higher defense, spending, and elevated issuance come just as foreign ownership of treasuries has fallen from roughly half of the market to near one-third over the past 15 years. Central banks are gradually shifting reserves toward gold and away from U.S. debt, and domestic buyers appear more comfortable in short to intermediate maturities than in the long end. At the same time, bond-equity correlations have turned sharply positive in this inflation scare, which limits the diversification benefit of duration when growth and inflation shocks arrive together. Within that backdrop, there are pockets of income that stand out. Investment-grade corporate yield around 5% are described as historically attractive, supported by low default rates and strong buyer demand, while long-dated municipal bonds now offer tax-equivalent yields approaching 10% for investors in high tax brackets after the latest repricing. The tension is that these income levels look compelling just as the macro narrative warns of more upside risk to long-term yields if oil and labor-driven inflation persist. For cross-asset allocators, the main rates questions are whether upcoming inflation data force markets to price an even higher terminal rate, and whether any growth rollover in the second half reintroduces the prospect of one or two Fed cuts that could re-steepen the curve and restore some hedging value to high-quality duration. How those paths resolve will feed directly into equity and credit risk premia, which brings us to credit markets. In credit, public markets continue to look resilient on the surface. Investment grade and even parts of high yield are seeing robust demand, with strong appetite for new issuance from large technology firms and other blue-chip borrowers. There's an estimated $7.8 trillion parked in money market funds, and some of that cash is steadily migrating into higher-yielding corporate paper as issuers come with deals. Expectations that the U.S. economy slows but avoids deep recession later this year support the idea that modest policy easing, once inflation risks abate, could be a tailwind for spread tightening and capital gains in quality corporate bonds. Beneath that calm, however, stress is building in specific corners. Leveraged loans, especially to software companies with weaker cash flows, are under pressure and drawing comparisons with past energy sector default cycles, even if it may be too early to make that leap. In private credit, rising redemption requests, tighter withdrawal limits, and concerns over opaque valuations are surfacing. Some funds have brushed up against gates. Others have imposed stricter terms, and prominent bank leaders are warning that the lack of transparency and rigorous loan marking could invite closer regulatory scrutiny, particularly from insurance supervisors. Default rates in private credit remain in the low to mid-2% range, and structures often have thick equity buffers, which argues against systemic risk, but investors are clearly becoming more selective. The common thread is that cheap and abundant liquidity is gradually giving way to a world of more discriminating credit. With equity volatility elevated, energy potentially feeding a stagflation scare, and bond equity correlations positive, high-quality spread product continues to be supported, while weaker borrowers in cyclical or highly levered sectors face tougher funding conditions. For allocators, monitoring credit spread behavior around the upcoming earnings season, particularly in financials and in rate-sensitive sectors, will be key to gauging whether today's tight public spreads remain warranted or start to reflect the underlying stresses already visible in leveraged loans and parts of private credit. These signals will also inform how durable the current equity resilience really is. In foreign exchange, the U.S. dollar has reasserted itself as the dominant safe haven. As expectations for Fed cuts this year have evaporated and even the risk of additional tightening is discussed, the dollar has outperformed traditional refuges, such as gold, during recent bouts of geopolitical stress. Recent client flows show global investors rotating out of Europe and back into U.S. equities, reinforcing the perception of U.S. assets as the relative safe harbor in a world of elevated energy prices and supply disruption. There is also talk of a potential breakout in the dollar that could reverse last year's pattern, when a weaker U.S. currency had favored non-U.S. equities and precious metals. A stronger dollar from here would tighten financial conditions for many import-dependent economies and could redirect capital toward U.S. mid-cap and infrastructure exposures. At the same time, longer-term questions about dollar primacy are slowly building. Foreign central banks are net sellers of treasuries and now collectively hold more gold than U.S. debt, reflecting worries about asset freezes and the geopolitical leverage that comes with dollar dominance. The traditional petrodollar loop, where Gulf energy revenues were routinely recycled into treasuries, is under strain as tensions with Iran and concerns about maritime security grow. Parallel to this, digital assets continue to evolve, with Bitcoin still in a broad basing pattern and certain listed equities acting as high beta proxies for crypto sentiment, while a trend toward tokenizing traditional funds hints at a more blockchain-native financial architecture over time. For allocators, the near-term focus remains on the dollar's behavior around each new inflation or geopolitical headline, because further dollar strength would amplify the energy shock for the rest of the world, even as it supports U.S. financial assets. In commodities, oil and related energy markets remain the central macro driver. The effective closure of the Strait of Hormuz has severely constrained crude exports from the Gulf, pushing Brent prices from around $60 to roughly $108 in a short span. Even with reports of partial resumption of shipping under selective safe passage arrangements, transit volumes are still well below pre-conflict levels and logistics remain heavily disrupted. Market participants note that even if hostilities ended immediately, restoring full flows could take 1 to 3 months because of vessel backlogs, damaged infrastructure, and safety concerns among shipping crews. There is also a meaningful risk that damage to key facilities, particularly in Qatar, takes years to repair, implying a prolonged period of tight natural gas, sulfur, and helium supply. The consequences extend far beyond crude. Disruptions in Gulf exports are lifting costs for chemicals, plastics, fertilizers, and semiconductor inputs, while rerouted tankers and constrained air freight capacity are driving up shipping prices on routes between Asia, Europe, and the United States. U.S. gasoline and diesel prices above $4 per gallon underscore that domestic supply abundance does not insulate consumers from global shocks. Hedge funds have turned net long Chicago wheat for the first time in years on fears of fertilizer shortages and weather issues, signaling concern for global food prices. All of this layers an energy and food shock on top of already sticky core inflation, reinforcing stagflation risk and raising the probability that central banks are forced to keep policy tighter for longer, even as growth momentum slows. Positioning and derivatives markets underline how nervous participants have become about further upside in commodities. Oil option structures show an unusual premium for upside protection, suggesting persistent concern that crude could test technical levels closer to 130 or even amid 140s if the Strait of Hormuz remains compromised or if attacks on energy and desalination infrastructure escalate. Yet there is a sense that broader asset prices may still be underestimating the duration and severity of these supply risks, given how modest the pullback in global equities has been so far. For multi-asset allocators, the path of Middle East geopolitics, shipping, and energy infrastructure now sits at the core of the macro regime. It will determine whether the current environment settles into a manageable, mildly inflationary soft landing or tips into a more disruptive stagflationary scenario with deeper repricing across equities, rates, and credit. Pulling it all together, the cross-asset picture today is one of resilience under stress. Equities and credit remain broadly constructive, led by AI-enabled technology, defense, and high-quality corporate balance sheets, while rates markets slowly adjust to the idea that policy may stay tight for longer. The dollar is firm, exporting the energy shock, and commodities are signaling that supply disruptions and geopolitical risk are far from resolved. For allocators, the crucial variables now are upcoming inflation releases, bank and energy earnings, and developments around the Strait of Hormuz, which together will shape the debate between soft landing and stagflation. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.